Because I'll tell you right now, one of the most significant risks for Canadians is the belief that the Bank of Canada issued a serious warning this week with respect to interest rates. And that is not to expect that interest rates are going to fall anytime soon. And this comes on the heels of the Bank of Canada pausing its interest rate increases, which has led many to speculate that lower interest rates are right around the corner. However, Bank of Canada Governor Tiff Macklem this week was clear to point out that the Bank of Canada does not have any plans to lower interest rates anytime soon. In fact, the conditional pause in interest rate increases is more about collecting data than anything, and the Bank of Canada is still prepared to make additional increases to interest rates going forward. And these statements are a very important development for Canadians, because anybody who is right now making buying decisions based on the expectation that interest rates are going to go down is making a bad choice. And I'm going to discuss all the details about how you should be making your buying decisions, especially when it comes to borrowing money, later on in this video. But before we get into it, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me that favor, hit the subscribe button and hit the like button so more people like you can see this video. And don't forget, for a limited time, you can get my new book, Mortgage Secrets, at mortgagesecrets.ca. All you have to do is pay the shipping and handling. But when the book goes on Amazon later this month, this deal will go away forever, so make sure you get your copy now. Okay, so without further ado, let's get into the serious warning from Tiff Macklem and the Bank of Canada this week with respect to interest rates and the false expectation that interest rates are going to go down by the end of 2023 and everything will go back to normal. Because while this is possible, it's not necessarily the case. In fact, it is starting to look more and more unlikely every single day. And what I want to do is I want to start by talking about exactly what Tiff Macklem said. I want to show you what the problem is with respect to how Canadians and Canadian news outlets are handling this issue. And then I want to talk about what you need to do when you're making borrowing decisions going forward in 2023. So let's start first and foremost by taking a look at the article from the Financial Post. Now, normally I would turn to BNN on this. However, the Financial Post had the best coverage of this speech that was given on Wednesday. And as you can see from the headline, the Bank of Canada is making it very clear that they will not be cutting interest rates anytime soon. In fact, they went on to say that they are prepared to raise policy rates further if necessary. Now, this is important to note because I'll talk a little bit later on in this video about what's happening in the US and how that could affect the Bank of Canada, because the Federal Reserve in the US is taking a substantially different position with respect to inflation than the Bank of Canada is, and that could have a lot of repercussions for what actually happens to Canadian interest rates. But I want to pull out a few quotes from this article. First and foremost is this one. The Bank of Canada Governor Tiff Macklem said market participants who interpret his decision to take a break from raising interest rates as a prelude to cuts might be getting ahead of themselves. And his exact quote is, "I want to be very clear. We are pausing interest rate hikes to assess whether we raised interest rates enough to get inflation all the way back to target. Monetary policy works with a lag. We've raised rates rapidly. We're seeing the effects. We know there's more to come. It makes sense to pause and assess whether we've done enough." So in other words, what they are not saying here is they're not saying that they're going to reduce interest rates because they're near the end of a rate hike cycle. What they're saying is that they're pausing to assess and that this may not be the end. Now, granted, Tiff Macklem a few years ago said you could expect interest rates to be very low for a very long period of time, and then put out projections that said that they probably weren't going to increase interest rates till the end of 2023. And obviously that was long, so take that into consideration when you're taking these words at face value. But know right now, from a psychology perspective, it does not seem like the Bank of Canada has any intent of reducing interest rates by the end of 2023. And it's important to note that there's a significant amount of concern with respect to the global economy and the effects that it could have on Canada's inflation, especially with China reopening. And I want to read you exactly what was said here. The biggest risk is that global energy prices could increase, pushing inflation up around the world. We are also concerned that inflation expectations could remain elevated and increases in labor costs could persist. If these upside risks materialize, we are prepared to raise interest rates further to return inflation to the 2% target. And the Bank of Canada reiterated this yesterday when they released their summary with respect to their most recent deliberations. And I'll link to the video where I discuss that at the end of this one, but it's important to note that they are concerned specifically with what is happening in China and the lifting of China's zero COVID policy, which could create a significant amount of demand in China's economy, including for oil, which could lead to higher energy prices, which has been the saving grace for inflation in the last 3 to 6 months, is the fact that energy prices have gone down. But with China reopening, that is one of the biggest risks to the Canadian economy, is that energy prices increase as a result of that higher demand for energy from China's economy. And there's another big problem for Canadians as well, and that is the US approach to inflation, and the fact that Jerome Powell is bracing for a longer fight against inflation, which means they could start increasing interest rates at a faster rate than Canada. And while Canada pauses, if the US Federal Reserve continues to increase interest rates, that could have a significant impact on the Canadian dollar. And in the event that it made the Canadian dollar significantly weaker, that would mean that there would be more demand for Canadian goods from countries that we export to, which could cause the prices for our locally grown goods and our locally made goods to go up significantly, further adding to the inflation problem. So, not raising interest rates or lowering interest rates could have an inflationary effect because of what's happening outside of Canada, especially with respect to the US. And here's the primary problem is that inflation is operating in a lag. And in December, it seemed like there could potentially be lower interest rates coming in the near future. Oh, look, there's my buddy Tom's story. And at that time, it seemed like Canada's economy was starting to contract. But in January, when we started to get third quarter data and the beginnings of fourth quarter data, it looked like GDP was actually increasing at a faster rate. So all of those predictions with respect to interest rates going down at the end of 2023 are still being reported on currently as if they are the current predictions. And that's simply not the case. Because if you look at the most recent data, the likelihood of interest rates going down in 2023, late 2023, is becoming less and less likely. In fact, at this point, if you just use the data from today, and keep in mind that data changes on a regular basis, but if you use the data from today, it appears that there's almost a 0% chance that the Bank of Canada will be lowering interest rates in the near future. And yeah, I know people don't like certainty, they don't like predictions. So let's say it's a 5% chance that they'll lower interest rates in the future. So with media outlets like Global, as of today, reporting that you could see lower interest rates in 2023, well, that is one of the biggest risks to the Canadian economy and to you as an individual if you're making borrowing decisions based on this information. Because here's the reality of the situation is nobody knows where interest rates are going to go in the future, whether it is later on in this year or into 2024 or 2025. And the Bank of Canada, based on the summary that they provided, is clearly concerned about what is happening and is definitely taking a stance that they would rather be more restrictive than less restrictive. So in other words, they're more likely to start increasing interest rates again than they are to start decreasing them anytime soon. And it's my guess that when the economy starts to show signs of cracking and signs of the fact that interest rates do need to start to come down, the Bank of Canada is probably going to be slower to react in order to make sure that the job of getting inflation back to 2% actually gets done. So if you're choosing a variable rate mortgage right now, thinking that rates are going to come back down to where fixed rates are, or you're picking a short-term mortgage because you think you're going to be able to time the market and get into a lower rate 2 or 3 years down the road, well, you need to reassess your risk. And you need to start looking at the possibility of what happens if interest rates go up, then make your borrowing decisions based on that. And if you happen to pick a 3-year fixed or a 5-year fixed mortgage and you get it right, then you win. But at least you've backstopped yourself from higher interest rates if they do continue to go up. Because I'll tell you right now, one of the most significant risks for Canadians is the belief that interest rates are going to go down and people start consuming based on that belief. And that is why Tiff Macklem has been so adamant in suggesting that they aren't going to lower interest rates anytime soon, is because that belief is almost as big of a problem as inflation itself. So I'm going to link to that video here where I talk about the summary of their deliberations. It's really interesting. They talk about a lot of things, and I think I did a really great job of translating it from economics to plain English. So check it out.